Oh god, that was a good one.
Yep.
Joanna, the screen went off, which was exciting.
So on that graph, though,
Yeah.
I can give kind of the play-by-play of like what actually happened
Mhm.
at different moments in time along the
Okay.
graph.
Cool.
And then I put the chart together to show the effective interest rates and home prices and that other good
I
stuff.
like that about you.
Hey, what do you know? I don't know if that was really necessary for me to explain all that to you. I feel like we would have just gone over that, but
Yeah, YouTube knows now.
that's
We
true.
gotta turn the lights on. Turn
Hey,
the lights on.
lights up. There, YouTube. You just saw the prep for every show right there.
There you go. This is why you tune into the live. All right, here we go. Ready?
Yep.
Oh man. Okay, here we go. Welcome, everybody, to your weekly edition of the Not Your Average Investor Show. Today, we are talking about a profound change in policy that is happening that most people don't talk about. When people say the end of quantitative tightening,
Oh, yeah.
just so many syllables, my eyes glaze over. But this may be the most
It's
impactful
beautiful. It just rolls off the tongue, doesn't it?
quantitative tightening. My eyes glaze over. GC jumped on this as an opportunity to talk about like maybe one of the most important policy decisions of what is going on and how it affects investors. We're going to talk about that today. I'm your host, Pablo Gonzalez. With me, as always, in the JWB Studios, world famous JWB Studios, is the man that I affectionately like to call GC because he's got the genius concepts, knows how to generate cash flows, is a great co-host, and because his name is Greg Cohen. GC, you get it?
I get it.
Say hello, GC.
Hello, everybody. Great to be with you.
It is good to be back in here, bud. And we have a time-old tradition that we like to honor here, which is called what?
The roll call meeting.
The MVP kicking us off.
Mr. Lee Bishop.
Lead off hitter, batting off second.
John Henning.
John Henning. Who we got in here? We got Le Monsieur from London, the Bay.
Rigid Fonseca.
Richard Fonse, bonjour. We've got the ringmaster.
Drew Barnell.
Milady is
Jag
back in
Chad.
the house.
Nice to see you, Jag.
Yeah, we've got the Maven from the mountains of Denver.
Leslie Wilson.
Leslie Wilson. We got the KOB, King of the Beach.
Christopher Lee.
Christopher Lee. We've got the man from the illustrious Hudson Valley in New York.
Oh, gosh, Chris Gonzaga. Oh my gosh. You know what? I was reading the Not Your Average Guest,
Maybe
the next one.
you should
Chris Gonzaga. I am sorry.
Get out of your head and
I was
into
reading.
your heart. You know these answers.
I know these answers. I was looking at Not Your Average Guest because I had to read because it wasn't there.
Well, we call him Sir Jeffrey Bolton.
Of course.
Do we have a nickname for Sir Jeffrey Bolton? I think it's Sir.
Sir Jeffrey Bolton.
Got it. Laura Colby from snowy Washington.
I think Laura needs a nickname
Laura
too.
needs a
She's just awesome.
Needs a nickname. Yeah, I agree. This guy has a nickname.
Billy Green.
We've got the regular guy with extraordinary questions. Mark Norman. Yeah, that one I don't expect.
Mark Norman?
Yeah.
Oh no, there was Mike Foster.
Mike Foster.
Yeah.
Well,
I'm here to keep you honest, buddy.
Yeah.
Here to keep you honest.
Mark Norman.
Mark, it's great to have you. I'm sure your questions are awesome too.
We got our regulars, Gary and Rosalind Riley from Murrieta, California.
We regard you.
We got the fairy godmother in the house.
Miss Jen Filson.
Miss Jen Filson, fairy godmother of the Not Your Average Investor community, checking in from Monterey, California. We got Belinda Baldwin from Dallas.
All right, Belinda.
New name?
I don't know. I feel like she's been here, but we are super happy to have you.
Ehab Eskander.
All right, Ehab.
Good to have you, Ehab. Aurora Carp in the house.
All right.
Aurora. LinkedIn Lowry in the house.
LinkedIn Lowry. Ed Lowry saying hello.
Saying good afternoon from a rainy Jacksonville, hence
the
rain jacket that I'm wearing right now. We got our favorite smile from the Pacific Northwest.
Pamela Myers.
Pamela Myers. Good to say your name again, Pamela. We got the Shaw Man in the house.
Nadeem Shah.
Also from the Pacific Northwest with his trademark good morning, good afternoon. We got Linda Mercurio.
All right, Linda.
She says, I've nosed the past 3 weeks. I am assuming she says she's missed the past 3 weeks.
Yeah, unless nose is now the colloquial term for missed.
They're good to have you back. Yeah, I feel like a lot of these names I haven't said it.
You know what I'm thinking? This better be the group that we have for Summit plus more, but I hope we get to see all of you here for Summit coming.
Sure. Including Renee Palladini.
All right, Renee.
Chile, Northern California. Good to have you in here, Renee. Who else we got in here? This is good. Oh, Il Maestro has checked it.
John Williams, of course.
It's world famous composer from Long Island, New York. Here we go. Checking in. Okay, I think this is Joyce.
New name.
Crayley from Florida.
All
That's
right,
a new
Joyce.
name.
Welcome to the party.
Welcome to the party. Jeff Pettijohn from Missouri.
All right, Jeff. Good to
Jeff.
see you.
Not a new name at all. Good to have you. I was listening to a podcast recently about this guy that bought a town in Missouri.
Bought a town.
But yeah, well, it didn't buy a town, but he's like rebuilding a town in Missouri. He was the founder of Ring Doorbell.
Oh, cool.
Right? It was a really cool thing. Anyways,
Love
he
that.
said Missouri over and over and over as a local Missourian. Made me feel pretty good about my choice of Missouri.
I think you should.
Missouri.
I think you should.
Yeah, I agree. Excellent, man.
Yeah,
speaking of the summit, man, do we want to remind everybody to save the dates?
Yes.
What are these dates? Chief?
February 19th to the 21st, 2026. We are doing, is this the 6th summit? 5th summit? I don't know.
Gosh, we started 2022, or maybe end of 2022.
We'll figure it out before we get there. But it's either the 4th, 5th, or 6th summit. They're awesome, though. They get better and better every year.
It's the best summit.
It's the best one yet.
Best one yet.
All of us, many of you who are in the crowd right now are going to be there. You show up every year because it's a great opportunity to get connected, to get out of, Zoom land and get IRL in real life and hang out against the backdrop of a wonderful investment to learn more about single family rental properties, turnkey rental property investing. Get to meet the JWB team here who works so hard to serve all of you and loves all of you. And against the backdrop of what is really happening behind the scenes in downtown Jacksonville. And this year, it absolutely is going to be the most fun downtown tour that we take. Because, guys, what we have been talking about and you all have been seeing for 3 years, 4 years, 5 years, however many years we've been doing this, it's happening now. We get to enjoy that success today. And then, of course, you'll be in the know for what's coming next.
Are we allowed to talk about one of the places that we will be visiting in the summit that I think we've been talking about for a long time, has not been open to the public? That we are going to.
Oh, you're talking about our office?
Yeah,
we can talk about it. That's why we're hosting it.
Yeah.
So. I think so. I think so.
I don't remember.
I mean, my business partner who's running the renovation, it's not completed yet. I was actually just walking through the building this weekend. It's not completed yet, but he told me it's going to be ready come summit. So I said, I'm going to go live with it. We're going to be there. He said, okay, put the pressure on. So yes, JWB is moving our headquarters downtown. We're super excited about it. All of downtown is excited about it. And that'll be happening beginning of February-ish. Just in time for us to showcase our new office and host this year's Not Your Average Investor Summit in our office. You guys are going to be blown away. It's one of the biggest milestones for our company to be able to move downtown and kind of live out the mission of how much we care about our city, and to also connect the dots on how that care and how that commitment to downtown translates to you as an investor, and how that translates to our residents, and how that translates to our community at large. So super pumped, and we are definitely going to be in the office.
It was, I believe, the second summit when we're doing the tour. So we've walked past the new JWB HQ multiple times. It was the first time that we walked past it with a tour that everybody looked up and we saw there's like an old plaque up, not a plaque, it's like a stone at the top.
The building was built over 100 years ago.
Over 100 years ago, and the building has a stone that says GC.
It's incredible.
So the Not Your Average community, we call it the GC building. We've walked past it a bunch. We've made the joke many times, but we haven't been inside. We're not only, I wasn't gonna make you commit to like hosting it in there, but we're not only gonna walk inside the GC building for the first time, we're hosting the summit inside the GC building. It's going to be awesome, man.
It's going to be great.
It's going to be awesome. So what were the dates?
February 19th to the 21st. Keep tuning into the shows because we are going to make tickets available on a show that is coming up sometime soon. We don't know exactly which show it's going to be yet. We're still figuring out how to do all things behind the scenes. But keep coming up to the shows. Because we'll announce tickets here and give you the opportunity to purchase your tickets. And it's going to sell out. So you definitely want to be on the show.
That being said, one of the big things that people ask for is travel plans, right?
Yes.
So like, feel free to book your travel now, right? Arriving on Wednesday the 18th.
That's right.
Arriving Wednesday the 18th. Or do we want people arriving Thursday summit?
We have activities on Thursday.
On Thursday. Okay. So we want Thursday.
So you'll want to arrive on Wednesday. Get in late on Wednesday or whatever time you get in, get settled. Thursday, there are going to be JWB and Not Your Average Investor Show activities here Thursday.
Get here on February the 18th. You can plan to leave on Sunday the 22nd.
There you go.
but you want to be here. So if you want to go ahead and book your travel, do all that, right? Like plane tickets, all that good stuff. You can start doing that now. If you have booked your travel, you have to be a JWB investor
You do.
to come to the summit, right?
Mhm.
So like if you have made the commitment of booking your travel, let us know you booked your travel. We will save you a ticket. How about that?
Well, I'm not sure exactly what you're asking. Are you
I'm telling people to book the travel and not be afraid that we're going
book
to.
your travel? If you're not a client, sorry, I didn't know if you're going down
Yeah.
this direction. If you're not a client yet, you have time. Get on the phone with us, explore this investment, and obviously you're going to be making a great investment decision, and then you'll get to enjoy your first few months of a JWB client here at Summit. The best way to introduce you to the community.
And if you are a client, you can go ahead and buy your tickets.
Yes.
Buy your plane tickets.
Buy your plane
We'll
tickets.
get you a ticket.
We'll figure out the tickets. We'll announce the tickets to the event on the show, and then we are figuring out logistics as far as where to stay. So
Yeah.
don't book that yet. That's coming in the coming weeks. We're gonna have that
Yeah.
figured out.
Jen Phil's and Fairy Godmother, feel free to buy a plane ticket.
Buy a plane
Right
ticket.
now. Yeah, you're good. You're good. We'll get you in.
There we go.
All about who you know. All right, so that was a big one. I don't think we've talked about the fact that it was going to be in the HQ. So
It's
that's
super exciting, man.
it's dripping out information like professional
You
marketing.
know, that's what we do.
We deliberately, we know what we're doing, folks. That being said, things that are happening in the world right now.
Yeah.
This idea, I remember the first time that you talked about the end of quantitative easing was probably about 2 years ago, 3 years ago.
Yeah.
I had no idea what you were talking about. The same way as when I first read this, I read end of quantitative tightening, and I'm like, I'm not really sure what this means.
Yeah.
GC, first of all, like before we explain what it is, why does it matter?
These policies are Fed policies, and it matters a lot for our everyday activities. We understand how much interest rates affect the cost to live, to be a citizen, and of course to be an investor. Interest rates really do dominate our lives. They dominate a lot of things. Well, you can start to go backwards from what the interest rate decision is and start to look at what are the mechanics that lead to the interest rate today. And when there are shifts in policy from the Fed, what you start to see is things come down the pike. And the value for understanding it early is you can start to make decisions now, take advantage of it. But it's a crazy convoluted web of things that come to fruition to make our interest rates what they are today. So the reason why I was so excited and I hit up Pablo and said, hey, I think we should shed some light on this is because there are some shifts that are happening with the Fed policy right now that haven't happened in a while. And I think it is more of an opportunity for us to say, hey, let's pay attention to this. This is a shift. Let's see where this goes because, and I'll share some examples in the past, where it has gone in the past has been extremely influential, not only in the interest rates of that day, but the interest rates for years and sometimes a decade later when you start to think about the ramifications of some of these policies.
Yeah, and we talk a lot about headlines and liquidity and how much things change, and we like the fact that real estate is a hard asset that isn't super liquid because it's not prone to these spikes in this tweet economy and all this type of stuff. And to me, this news is a much more permanent thing, right? Like it's not like a headline of today of something changing overnight. This is like hey, you can bank on the idea that for the next couple of years, this is the direction that the winds will be blowing, right?
Yes and no. Because we can look to some other examples and crazy things happen in the world and the policy shifts again dramatically. You go to COVID era and the pandemic and things dramatically shifted. So I think you're on the right path when you start to say, hey, shifts in Fed policy do not happen flippantly. There is a lot of thought that goes along with it. And we can say, that signals something here. But does that mean it's going to be this way for the next few years? No, I think this is more of hey, this is a signal. Things have shifted. We need to be hypersensitive as to where this goes from here because and really we need to deduce this down to how can this help us make better investment decisions. And I think we can do that.
So at the very least, it's like a one big domino that will affect other dominoes.
Yes.
Right. So we can start thinking that way.
Yes.
Okay. So I'm gonna do my what is called the noble fool explanation of what I understand, right? Like I read the headline. The headline is essentially the Fed is going to stop shrinking its balance sheet on December 1st. And that means that we are going to we're going to stop draining liquidity from kind of like the system, right? Like we're going to basically like start injecting more money into the system, essentially is what it means. There's going to be more cash on these streets. Is that kind of what that means? Am I getting that correctly?
You're close.
Okay.
You're close.
All right. Explain it to me
Let's start
like a real
first with
professional.
what quantitative easing
Okay.
is and what quantitative tightening is.
Okay.
First of all, before 2008, these terms did not exist. They were made up in 2008.
Yeah.
And really what quantitative easing means is expanding the money supply, so putting more money on the streets. And, you know, the Fed can't just say, hey, let me print some money and just send it out to people. You know, we did that during COVID time, but it was Congress and the president that, they actually have to distribute that. So the Fed, they're limited in their ways to be able to inject money into the money supply. Mm-hmm. And they typically do this through adjusting the Fed funds rate, which mm-hmm. adjusts interest rates. Okay. So we all talk about what's the Fed doing dropping the Fed funds rate, right? Because for the longest time, up till 2008, that was their way to basically expand the money supply or reduce the money supply. Mm-hmm. And their job is to expand or reduce really the money supply based on what the economy needs. Mm-hmm. The economy is hot, inflation's roaring. They're going to reduce the money supply by raising interest rates. Okay, so that's the Fed's job. Mm-hmm. Prior to 2008, the only tool that they had really was interest rates. Well, 2008 was a great financial crisis, mm-hmm. and they came up with new tools. And they came up with this tool called quantitative easing. Mm-hmm. Quantitative easing. And easing. Easing. And in addition to dropping interest rates and the Fed funds rate as low as they possibly could, it wasn't enough. Mm-hmm. They deduced that they needed to do more. And they said, well, we can't just print money and just give it to everybody. Mm-hmm. They said, but what we can do is we can inject money into the economy, into the money supply mm-hmm. by printing money mm-hmm. and then buying bonds or by buying mortgage-backed securities. Okay. And that's a way that they came up with to be able to inject money into the money supply. And by buying bonds and by buying mortgage-backed securities, that lowers the interest rates for everybody there. That trickles down to everyday people because now your interest rate on your 30-year mortgage is lower because there's significant demand coming from the government mm-hmm. with basically an unlimited amount to print money. Yeah. So that was quantitative easing, mm-hmm. and that's what they did. Well, we're going to take a look at how much they did. Yeah. Quantitative tightening is the opposite. Mm-hmm. Again, prior to 2008, we didn't have quantitative easing. Mm-hmm. So the Fed does not want to carry a big balance sheet. Mm-hmm. They, in a perfect world, would like it to go down to probably what it was prior to 2008. Yep. So in order to do this, they create policies under quantitative tightening. Mm-hmm. And tightening removes money from the money supply, mm-hmm. the opposite of what expanding the money supply did. So they were buying bonds and mortgage-backed securities. Mm-hmm. Tightening has been the policy that we have been a part of for the last few years. And that has been saying, we're going to shrink the balance sheet of the Fed. We're going to take these bonds and mortgage-backed securities that we were investing in. We're just going to let them roll off. So we're reducing the balance sheet of the Fed. Mm-hmm. I know there's a lot of technical terms there. How did I do there?
If I can explain back what I heard, okay. Quantitative easing is essentially, well, I guess this is what I don't understand. Are they offering more bonds with quantitative easing or less bonds with quantitative easing?
They're buying bonds and mortgage-backed securities with quantitative easing.
So easing means I'm paying you to no longer own your bond, right? I'm essentially taking bonds off the streets.
Think of it. They're increasing demand for the bond. So it's lowering the interest rate of the bonds. It's increasing the price of the bond because there's more demand, which lowers the interest rate of the bond or the mortgage, the mortgage-backed security. So when they are easing, they're putting more money into bonds. They're buying bonds and mortgage-backed securities. We as people, we get happy in the moment because things cost less for us. Interest rates are lower, and that's really the net effect of quantitative easing.
Got it. So, okay. So in quantitative tightening, they are increasing the demand for bonds, and in quantitative easing, they're reducing the demand for bonds.
It's not about it's not so much about what they're doing as far as outside demand.
Maybe I'm getting held up on this idea of buying. Is buying really buying, or is buying another word for something that people just use because they're sharp, right? Like, is buying mean like I'm giving you more money more often, or does it mean like I'm going to take that bond that is yours and I'm going to put it back and now it's mine again, or it's no longer in circulation?
It's not about whether or not it's in circulation.
Okay.
The amount of bonds and the amount of mortgage-backed securities are.
Okay.
Let's just imagine you got the biggest whale coming in with unlimited pockets saying, I want that.
Yeah.
And I want mortgage-backed securities. And so in essence, the cost of the mortgage-backed security goes up for everybody. And when the cost of a mortgage-backed security goes up, the interest rate that we feel as an investor or as a homeowner goes down because there's an inverse relationship to the cost of a mortgage-backed security or a bond and the yield. And the yield is another way of saying the interest rate that we pay. Does that make sense?
Yeah, that makes sense. It feels like then it is basically a sign for lower rates coming.
Well, there's more to talk about here.
Okay.
So we just talked about quantitative easing, right? Injecting money into the economy, lower costs. We're all happy in the moment.
Yeah.
Okay. Quantitative tightening would be the opposite. It is tightening. It's reducing the money supply by shrinking the balance sheet.
Okay.
So, and then ultimately what happens is during that time, we pay higher interest rates, which is what we have seen for the last few years. It is a contributing factor to higher interest rates, along with many other factors. So times are tougher during QT as far as cost, because generally your interest rates are higher.
Yeah, interest rates are higher, so people want to have more bonds in their portfolio because you're getting a higher interest rate from the bond.
Well, that's another component to it as well. But just think about the amount of influence, like you, me, other people have, even money managers and pension funds and all that. That's significant demand. But when the U.S. government comes in and can print whatever they want, and they want to invest trillions in something, it moves the market. So it's like, how much influence do you, me really have? It's not even consequential compared to what the government can do at some of these times of QE or QT.
Got it. Okay. Got it. All right. So then what is I know that you wanted to show kind of like the effect of this and what's happening.
All right. So for the last few years, we were in quantitative tightening since, mid 2022 up until basically today. I believe December 2nd.
December 1st, right?
December 1st. Yeah. What's today? It's the 2nd. Yeah. Up until yesterday. We are no longer in QT. That's noteworthy. Okay. What that means is instead of the Fed systematically shrinking its balance sheet, what the Fed is doing now is it is taking the profits that it gets from its yields and it's reinvesting it. It's not reinvesting it into bonds and mortgage-backed securities at this moment. It's reinvesting it into T-bills. So it's not exactly expanding the money supply, but I think it is important to see what is going on here. The Fed is signaling a shift from quantitative tightening to now we're in a neutral phase.
Got it.
And the Fed doesn't do that knowingly. In fact, the Fed probably would like to have waited longer to shift from QT to neutral because their balance sheet is still high, which I think we should probably take a look at here.
Okay.
But they didn't. So the Fed, yes, is this an expansionary type move? I guess you could say that. It's not expanding the money supply, but it's not restricting it. It's going now to neutral. And over time, and I put some of the data together here, what you'll see is when you shift a policy over time, generally it follows a certain trend as far as interest rates. And I connected the dots to home price appreciation.
Got it. What do you want to start with first? Do you want to start with this graph, or do you want to start with this table?
Let's go to the graph first.
Okay, go to the graph first. All right, so I'm going to share this graph.
Yeah.
Tell me what we're about to look at here.
So I just think we just gloss over when we see big numbers, and we have no idea really what the Fed has been doing as far as its balance sheet. And think of balance sheet as like putting money into the economy. And again, this was never done prior to 2008. Now, since 2008, you can see that we had about $1 trillion of holdings on the balance sheet up until about 2008. And then when the Fed ran out of options from dropping the Fed funds rate, they fell in love with QE. And QE means that they increased their holdings of bonds and mortgage-backed securities. And see what has happened since then, right? 2 trillion, 3 trillion, 4 trillion, right? Then look at what happens in 2020. We went from, what is that, 4 or 5 trillion dollars to $7 trillion in a year. So if we wonder like where all of this, how were interest rates so low after 2020? It's because the Fed was an active participant in the mortgage-backed securities market. They were actively buying mortgage-backed securities. And what happens is they buy them, the demand goes up, the interest rate goes down for all of us, and then it sits on the Fed's balance sheet. But all of this is active participation in our economy, and the Fed would not like to do this. They would prefer to not have the majority of this. I'm sure they would prefer, and this is me pontificating here, but I'm sure they'd prefer to go back to pre-great financial crisis levels. So you can see what's happened in the last couple of years. We got up to 9 trillion through 2022. And you know what? Then interest rates started to go higher, right? And they've stayed higher. Well, one of the reasons is because the Fed has been shrinking its balance sheet. It has been quantitative tightening has been here for the last few years. And so you start to see a serious correlation between quantitative easing and resulting in lower interest rates and quantitative tightening resulting in higher interest rates. Now we just made the shift from quantitative tightening to neutral. Where we go from here, we should really pay attention.
Got it. When we say that the Fed's balance sheet rose, right? Like when I think of a balance sheet, I'm thinking of like the assets versus the liabilities that something holds. I've never thought of it as like the balance sheet total rises. Does that mean that both assets and liabilities rise, right? There's just like more stuff that you are carrying that can be an asset or a liability versus like stuff you don't own that you're just kind of like letting other people own. So basically they're becoming a bigger consumer in the world of money in relation to the average American.
100% since 2008. It's undeniable. Their participation in the market is way more than it was, to the tune of 9 times more than it ever was before. And that really matters because now when the Fed makes decisions, those decisions have ramifications that affect interest rates today, along with a crazy web of other things.
Got it. Okay. So essentially, there is the government's actions create, when they have a higher balance sheet, the government's actions increase its influence on where things move. Essentially is what you're saying. Right? So got it. And right now we're at a moment when we're at an all-time high of like concentration of the government as the consumer, like as the market share versus private citizens and companies and whatever. And it's kind of like come back down a little bit. And now they want, and that was by design, right? Like it was by design where it increased. Then they came back down a little bit. Then they decided to come back down some, right? So now it looks like based on that chart, somewhere close to 2020 levels, maybe a little bit lower. And now we're saying, okay, cool. Now we're going to kick it into neutral and we're going to let the market play out without us increasing or decreasing our influence, at least for a little while.
For now, yes.
Increasing or decreasing our market share.
Market share influence, I think, are synonymous there. You know, this isn't something that the Fed wanted to do. They did it because they didn't have any other options at that point. They have been constantly in search of how can I maneuver the economy to a point where I'm not going to create panic and, they are trying to do a soft landing. But the big thing that they need to do is to decrease the balance sheet because they don't want to be an active participant in it. We're trying to get back. Will we ever get back to whatever the balance sheet was of the Fed in 2008 and before? Seems unlikely, but it's a problem that the Fed is constantly trying to chip away at. But now they said we're stopping chipping away.
Why would I, as a real estate investor, either want the Fed to decrease or increase their balance sheet?
Well, when the Fed has a really high balance sheet and you know that they don't want to have the balance sheet, then they are not going to be a buyer of mortgage-backed securities. And what they're also going to do is to let those mortgage-backed securities come into the marketplace, which increases the supply of mortgage-backed securities. So why do we care about all this technical mumbo jumbo that we're going through here? It's because this is significant for interest rates. And we know as rental property investors that home price appreciation is the biggest profit center for us. A lot of that is determined by interest rates. So if we know we have this big problem with our balance sheet of the Fed, and we know that the Fed would really like to let that roll off, but they said, no, I'm not going to do that anymore. This is likely to have some effect on lowering interest rates as we go into 2026.
Got it. Is this what this chart that you put together is kind of like an example of?
Yeah. So, I mean, that's the thought process. And then I wanted to go to the data. So I put, so you can start to see, I went back and I looked at other times where we had QE, quantitative easing, the years there. I said, okay, well, is that expanding or reducing or neutral as far as the money supply? And what happened to interest rates and what happened to home price appreciation here? So this is kind of putting this all together. I think this is one thing across many things to look at that could lead to the case of some interest rate relief as we go into 2026. It's because the Fed is no longer increasing the supply of mortgage-backed securities, right? They are now neutral. So as you look at QE in 2010 through 2011, it was expanding the money supply. You can start to see some correlations here. And these are small correlations, but a 0.25% interest rate drop over an average of a year is actually quite substantial. It doesn't typically happen. So average interest rate to start was about 4.7. It was 4.45 the year following that. And then home price appreciation. I took total home price appreciation over the next 5 years. You know, QE in 2012 and 2014, you know, interest rates interestingly went up from 3.7 to 4. My theory there is like, how much lower could they really go absent of a pandemic?
Little did we know.
Yeah. And look at the home price appreciation over the next 5 years. You had about 40% home price appreciation. And then QE in 2020 and 2020 through 2022, of course, that was COVID pandemic. But interest rates, because we injected so many trillions into the economy, still went lower from 3.1 to, you know, about 3%. And you can see what happened for home price appreciation. So right now, we have shifted from tightening to neutral as far as the policy of the Fed. And our average interest rate right now is for this year is 6.64. Right now, it's about 6.3.
Okay.
It's interesting to see what do interest rates do next year. And really, any type of interest rate relief is going to spur demand for home buying and is likely to see higher home price appreciation than you otherwise would have seen if you didn't have lowering interest rates.
Got it. Okay. So, I mean, you know, like this is heady stuff, right? Like it's like very like, man, it doesn't seem very tangible for an average investor, right? Like, but I think if we look at these charts, I think what I'm taking away is there's a solid chance that interest rates go down. There's a solid chance home price appreciation goes up based on this like big domino of quantitative tightening stopping, right?
I think the takeaway here is that this is one of a myriad of factors that is leading us to think that interest rates are going to come down at least slightly as we go into 2026. This is not the smoking gun that says, oh my gosh, interest rates are going to go down 0.5% or 1%. There's way too many factors that are coming here, but this is one that people aren't talking about. And I think I don't know how impactful it's going to be, but history has shown us maybe about 0.25 point, you know? And I don't know that that's exactly what it's going to translate to, but any type of interest rate relief, if you believe interest rates are going to go down next year, you should equate that with higher home price appreciation. And when you equate that with higher home price appreciation, you're going to see your return on investment go up by buying and holding an asset.
And I guess this chart kind of shows the idea that like, whether it's, again, you know, we're not saying that this is like a one stat in a vacuum that affects everything. We're just saying it's likely to affect, you know, it's likely to happen this way, right? So this is showing that while we may expect interest rates to go down, it doesn't always go down. That's what we saw 2012 to 2014. But in either way, you know, you are still seeing that either way, the effect is an increase in home price appreciation based on like the examples that we have in the past.
Yeah. If you want to think about how to grow your profit pie the biggest, you should look for moments where you see higher than normal home price appreciation coming.
Yeah.
Dropping interest rates. Is it over the next year? Is it over the next 2 years, 3 years? It's likely to happen. And if you're buying and holding an asset, a rental property for a 10 to 20 year cycle, you're setting yourself up for higher than normal home price appreciation because of the effect of dropping interest rates.
Yeah, cool. So I think this is a good time to do a in-show ad read for
I love it.
NWB. So if you want to take advantage of, this period of likely increased home price appreciation, or you want to take a look at your at investing in rental properties with JWB, go to chatwithjwb.com, or you can call the number 904-677-6777. I've only added the phone number to call to my repertoire. I still don't have a text number. GC, what's the text?
I got you. 904-293-0341. Shoot a text. Live person on the other side. We'll respond to you.
Got it. So that being said, GC, we got a couple of questions here. First is Mark Norman asking, won't expanding the money supply be inflationary?
It's a great question, Mark. So that's why this is a complicated web. And that's why I think the signal is very important here. Where it goes from here, we just need to pay attention. To answer your question directly, won't expanding the money supply be inflationary? What's actually happening here is not expanding the money supply. So the Fed shifting from tightening to neutral is not expanding the money supply. If the Fed was reinvesting their proceeds from these loans that they have and buying more bonds and buying more mortgage-backed securities, that would be expanding the money supply. And that's not happening here. They're reinvesting them in T-bills, which are short-term loans, and it does not increase the money supply the way that we would traditionally think about it. So to answer your question directly, it is not expanding the money supply. Inflation is another thing. Is it inflationary or not? By itself, it should have what the Fed is thinking is that this is a way so that we can solve some liquidity in the short-term market without being inflationary. That's their bet.
Yeah.
There's a lot of things that go into inflation.
When I think about, if we're using this language of like quantitative easing or quantitative tightening or just neutral, am I wrong to think that we're not expanding the money supply? We've just stopped shrinking the money supply?
Bingo.
Got it. So
Bingo.
we just turned off. So we turned off before we had a faucet on, then we put in like a hose to suck out the water. Now all we've done is just like turn off any kind of motor that adds or takes
the
away.
Fed is basically saying like, all right, we're at like $6.5 trillion for our balance sheet. We'd like to go lower, but we're just cool with it being what it is. It's not going to shrink right now based on this shift in Fed policy. Whereas a month ago or 2 months ago, it was shrinking a little bit every single month.
Makes sense. Makes sense. And just on the terms of inflation, right? Like, I was having this conversation with Martha recently, and she's saying like, yeah, like we are now, like inflation is up and all this stuff is happening. I'm like, I feel like I'm uniquely qualified to talk to you right now because we've been talking about all this.
Right.
And not too long ago, we were at like 9% inflation.
Yeah.
Right. So this idea, I know that the Feds, from what we've talked about before, we want to get back to like somewhere around 2%. Right now, we might have gotten, it might have blipped up a little bit recently, but we're still somewhere in like the mid threes, right? For like,
I don't remember the last reading. I think it's right around 3.
Yeah, right around 3, right? Yeah. So this idea that, maybe there is like I see the Fed doing this as like a way, like you said, right? Like it's like this is a way to get the things that we want to happen without the bad things happening, right?
Yeah.
Like the bad things is too much inflation.
The Fed waited so long to drop the Fed funds rate because they are so scared about it being an inflationary move. So not increasing inflation and not having it spike again is at the forefront of the Fed's goals, so much so that they have even said, hey, listen, we will deal with some job losses. We will prioritize inflation staying within reins, even if people have to lose their jobs. That's interesting rhetoric coming from the Fed.
So again, there's things that are bad, and then there is the idea that like we need a little bit of that in the system to begin, right? Like we can't expect zero inflation. We can't expect zero unemployment. There's like these acceptable ranges of pain that we're willing to deal with in order to have a healthy ecosystem. It's kind of like what I was explaining to Marta. And like, while maybe unemployment has, I don't know what the last figures are, but it seems to be like at a healthy number.
It's historically speaking, yeah.
Historically speaking, it's low, even though it might have ticked up a little bit.
That's exactly right.
Inflation, historically speaking, is low, even though it might have ticked up a little bit as well.
Yeah, I'm not sure what. Yeah, I think we're probably around average for what inflation historically is.
Yeah.
But if you're looking at this from the Fed's perspective, they've got this big problem, which is the Fed balance sheet.
Yeah.
They would love to tick that away as much as possible, but they've got the here and now to pay attention to.
Yeah.
And they've got inflation to tamp down, and they've got employment, max employment, right?
Mm-hmm.
And it is a constantly moving thing. So it's a difficult needle to thread. But when they say we're going to stop taking down the balance sheet, that's significant, because what they're saying is like, it would be much easier for us to do the other things that we're paying attention to if we just kept it rolling off. But they're like, I'm not going to do that now. So they are feeling better about inflation is a signal here.
Yeah.
At the same time, we'll see what they do with actually dropping interest rates or dropping the Fed funds rate. That's another thing to pay attention to. All of these things are good things to pay attention to. And for me, the reason why I became so passionate about this is because I didn't know anything about quantitative easing, prior to 2008. Nobody did.
Yeah.
And I didn't understand how that was affecting things in 2010 and 2012. I didn't understand what these big Fed shifts really correlated to.
Mm-hmm.
But a lot of those big Fed shifts correlated to the best buying opportunities that I have ever seen.
Yeah.
So that's why I pay so much attention to the Fed. I'll try to do my best to break it down into real actionable items. This is one where it's like, this is a shift. I wish every time that the Fed shifted policy, I made a note about it.
Yeah.
Because the things that happen afterwards can be very dramatic and maybe set up a great buying opportunity.
If you understood then what you understand now around quantitative easing, what would you have done different in 2008?
I would have bought everything I possibly could.
Did you not?
I would have found other ways.
Got it.
In 2010, I mean, we were running our business, and man, that's a long time ago. So
yeah,
2010, we hadn't really hit our stride yet for selling turnkey properties and building this vertically integrated process. We were just kind of learning it. 2012 was our big year to do that. So I think as a new business owner, I loved rental properties. I had about 40 or 50 or 60 of my own at that point. But I was paying attention to like, okay, how do I run this business well? How do I get this off the ground? Now we're 20 years into it.
Yeah.
If I knew that QE was probably going to lead to decreased interest rates, I would be borrowing as much as I possibly could and locking in long-term rates and buying hard assets
to continue to add to your portfolio.
Yes.
Yeah.
Yeah. So this is not QE that we're talking about here.
Yeah.
This is a shift from QT to normal, to neutral.
To neutral. Yeah.
Significant to pay attention to is the premise here.
What I hear and what you're saying, right? I mean, there's like kind of like two things that I'm hearing in how you would have acted differently. One is you would have, when I hear I would have found more money, I would have borrowed more. I hear I would have talked myself into dealing with a little bit more uncertainty and a little bit more pain, knowing that the future was going to be brighter tomorrow if I put my chips in today, kind of thing, right? So like that's one thing I hear.
Yeah.
That's about accurate, right? So like me as an investor, like when I'm putting it through my filter, I'm like, all right, cool. So, we've talked about this, right? Like I'm right now in an active purchasing cycle of like figuring out my reserves and figuring out the amount of pain that, right? Like we talked about it in this lens, right? Like it's like, I know I have a turn coming up. I know I want to do a couple of things to this property, and I know I have a certain amount of reserves. So when I have the conversation with Marta, the conversation is going to be around, hey, like let's understand like how much risk tolerance we have on how much we want to like whittle down our reserves. How comfortable with how much reserves we will be in order to then take the rest of the money that we've saved, all the extra income we've gotten from our JWB properties, plus other stuff that we've put away into buying another property today, or do we wait until after the turn or whatever, right? Like I'm putting it through my filter of like, okay, so maybe now in this conversation, this is another thing to say, okay, well, if like we've agreed that our pain threshold is here, maybe I say, hey babe, maybe our pain thresholds can be a little here, or like our risk profile or whatever, because I'm seeing these other data points of
Yes.
like something that I would want to shift the needle of like, I think right now is an even better time than I thought than before of like, we should move quickly.
Yeah. I think you got to operate from both sides of the brain.
Yeah.
I think there's the conservative side, which is protecting your peace of mind. That's the most important thing.
Yeah.
Whatever we need to do to protect our peace of mind when we're making an investment decision should be paramount. And that is not always numbers, right? Some of that is, you know, the experience and the emotions behind this and all this.
Hence the need for a team.
Hence the need for a team and hence the need for reserves.
Yeah.
Both of those things, right? So once we figure out exactly what those are, well, we need to afford ourselves the opportunity to be opportunistic with a different part of our brain.
Yeah.
Right? You can be both conservative and opportunistic.
Yeah.
And so once you take care of number one, which is protecting your peace of mind,
yeah.
and that's a number, that's reserves plus some other things, team can help. Yeah. Then look for opportunities once you've taken care of that. Yeah. You know, understanding that interest rates, this is likely to lead to some sort of interest relief in a vacuum, what we just shared here today. Look at that as an opportunity because when interest rates go down, home prices go up.
Got it. Okay, cool. I like that. I like how we broke that down to me. Lee Bishop, the MVP. I think you've heard of him.
I have.
Has a question. From 2020 to 2025, there was a big bubble. It looks to be settling back to where it started in 2020. Do you think the Fed is going to continue to reduce its balance sheet and get back to the levels of 2008? So he's talking about a bubble as far as like inflation of the balance sheet.
Yeah.
Right.
The Fed would love to get back to not being an active participant. The Fed would love to get back to a place where they can just control the money supply through the Fed funds rate, which is largely interest rate manipulation is what they do. They would love to get there. That's the way they operated for however many years until 2008. So if we understand that, and they've made that very clear, then yes, the Fed would love to chip away and get that down. But the Fed knows that is so long. It is so far in the future for us to potentially, like it would take an incredible amount of discipline for the Fed to get that back down that I don't see it ever happening anytime soon. And, you know, because as the Fed does quantitative tightening, which is what it does to reduce the balance sheet, is that fun for us in that moment?
No.
Has it been fun for us with higher than we like interest rates?
Not particularly.
No, as an economy, we don't like that, you know?
Yeah.
And there's real ramifications because people can lose their job, you know, and then other bad things happen. So it is like the North Star that the Fed would like to get to. It's not going to get there anytime soon. It's definitely a lower priority than controlling inflation and controlling employment.
Makes sense.
Cool.
Okay, got it. Chris Gonzaga from the Illustrious.
Oh, I'm very aware. Sorry, Chris.
Asks a great question here. So if all people waiting to sell decided to hit the market, how would that affect this present scenario, quantitatively speaking?
And so if all people waiting to sell, I guess I'm a little curious, like sell what? If they wanted to sell their houses, decided to hit the real estate market, how would that affect this present scenario?
I guess yes, he says yes.
Okay, let's play that out. Let's say that everybody wanted to sell their property. You know,
Chris, are we talking about the house they live in, or are we talking about their rental properties? Right. I think. Anyways, continue. I want to hear that from Chris. But continue.
You know, you're talking about an environment where there's a lot more supply and little demand.
Yeah.
Right. Everybody wants to sell means that there's way more sellers than there are buyers. In that case, home prices would drop. Okay. Home prices are a big part, and home prices and rents are a big part of how we calculate inflation. It's a dominating factor for how we play with or how we calculate inflation.
Yeah, for sure.
So what would happen then? We're talking about a great crash, which we don't see happening, but let's play it out, right? Well, what would happen to inflation?
Inflation would drop big time.
Would drop significantly. The economy would be hurting because real estate controls a ton of jobs. Construction, you name it, right? Everybody would be hurting. What would the Fed do from an interest rate perspective?
Drop the heck out of the interest rate.
They drop interest rates as much as they possibly could, like they did during the great financial crisis. What if that couldn't solve it? What would they do next?
they would start quantitative easing again.
Dude, you're doing great, man.
Let's
That's
go.
right.
Yeah.
Because the Fed funds rate couldn't solve the problem. They got to go to this next thing that they made up in 2008.
Yeah.
And then QE would happen.
Yeah.
It would increase the money supply. What would happen to our mortgage rates?
Our mortgages will go way down.
Our mortgage rates would go way down.
Mm-hmm.
What happens when mortgage rates go way down for home prices?
People buy more homes.
You just went through what happened in 2008 up until now.
Got it.
So that's in a nutshell why I love this asset class. It is built to create financial outcomes for people because it is a critical need. It's a critical need for the government. It's a critical need for us. It's a critical need for our families, shelter, communities, right? And, it's very unlikely that home prices go down. But when you play the scenario out, the government can't have home prices go down significantly because it controls so many other sectors of the economy that they're incentivized to drop interest rates, do QE, and then, those who buy before they understand, before, the average person understands, can load up on these assets and then create a better financial outcome for themselves.
That was a great answer, man. I my head went to a different place, but before I explain that place where my head went to, what I heard from you just now is essentially, if that happens, that essentially is like the 2008 crisis.
Yeah.
And if that, and in the 2008 crisis, what's something you've been saying for a long time is that those homes that you bought in 2006, because you bought them well and they were cash flowing, they have done well over a full market cycle. So at the end of the day, there's like enough like safeguards in the system to know that as long as you are holding for a long time, if you create a scenario where you are good to hold it for a long time, AKA cash flow positive with a great operator in place, you will be fine as long as that happens. I also assume that if that happens, the rest of the world is melting down as well.
Which is what we saw.
And which is what we saw.
What happened in other asset classes.
To other asset classes and everything else going. So at the end of the day, kind of like, where do you want to be? Do you want to be in the thing that is like, most watched over and safeguarded to then do well later?
Yeah.
Or do you want to be in other things during this meltdown?
Yeah.
In a place where you're also getting positive cash flow and whatever, right?
100%, man.
The other place my head went when he asked, the reason why I asked the difference between residential and rental, is because like if everybody that's been wanting to sell their home for the last year is selling their home as a residential homeowner, chances are it's because they want to move to another home, right? Like that to me is, that is they increase the supply, but they also increase the demand in the same moment.
Yeah, that is likely to happen,
That piece. And then I also think like if you're a rental property investor, depending on the market that you're in, correct, Chris? So depending on the market you're in, maybe you want to move markets.
Sure.
Right? Then it's like, all right, then look at the markets that you're in. Are you moving to are you investing in a market where people are dying to get out?
Yeah.
Or are you investing in a market where people are dying to get in?
Population growth.
Look for population growth, look for the trends, look for the hottest employment markets with the lowest cost of living in the United States.
Do you know one of those?
I feel like I live in one of those right
You do,
now, right?
Yeah,
like I've been the beneficiary of that. So that is another question that I would ask in that moment, right? And that, of course, this is JWB's podcast. We sell Jacksonville properties, but like it just reinforces the thesis of JWB, right? So like this idea of like the Jacksonville market being this like beautiful, resilient thing because of it has all the good things, right? That's one thing. I also think as a rental property investor, if I've been dying to get out of my rental property investment, like I feel like if you've made it through till right now on rental property investing, the amount of people that are dying to get out of it have to like, why would you want to be getting out right now if you made it through this,
oh my gosh, if you've gotten anywhere close to it. This is why. If you ask anybody who has invested in rental properties and they've owned it for at least 10 years, I would love for somebody to tell me that they didn't have a good experience if they've owned it for 10 years.
Yeah.
Like I've thrown that out there many, many times. I don't think I've talked to anybody who truly did not look back and say, you know what? I made a bunch of money. Yeah. Where the pain comes in is about the experience and the short run of rental property investing, right? Because it's something that builds this wonderful financial outcome for you, but it doesn't change your life day one.
Yeah.
If you buy and you hold for a full market cycle, 10 to 20 years, you're going to be really happy, So, I don't, that's the key. You got to buy and you got to hold.
Yeah. Yeah, totally. Cool. I like it, man. It just keeps going back to this idea that like, this is a risk mitigated asset class across so many different layers,
Yeah.
if you ask me, right?
Right.
Like because of the market, as we just said,
Yeah.
because it's a critical need, as we just said, right? Like, yeah, it's an interesting conversation. We have a couple more questions here in 5 more minutes. Let's see how many we can jam through.
Sweet.
MVP Lee says, what do you think New York could possibly do to enable affordable housing and not allow it to happen to the rest of the US?
What could New York possibly do to enable affordable housing and to not allow it to happen to the rest of the US?
Yeah. You know
Um,
what? Before we get there, something that Steve White just put in the chat. You have to get through the first 4 years of the suck, and then cash flows increase. That was another conversation I'm having with Mark, though, right? Like
Yeah.
we are talking about Minosa, has been our most painful rental property.
Yeah.
Right. And we're just like, well, what if we just kind of like 1031 it to another property? Why don't we sell it and go to another one? And I just keep going back to the idea. I was like, I feel like everybody that I talk to that has, I've talked to so many people. I just got back from that real estate investor mastermind in Vegas for like property managers, right?
Mhm.
Like everybody in that room was just like, every single property that I have sold, I wish I would have held on to.
It's 100% right. I get so sad for people who just say, you know what, I'm just going to sell this asset and go to another one. You worked so hard,
Yeah.
and your financial terms that you have with that investment are largely so much better than what you're going to get if you go to another property. A lot of times the reason people want to potentially sell and go to another property is
Yeah.
largely emotional.
Yeah.
And you generally make so much more money when you just buy and you hold. And the reality is that, like, you had a challenge with Mimosa.
Yeah.
You have two other properties, right? I guarantee you that your next 5 years, you're gonna have a challenge with another one, and Minosa is gonna be your shining star.
That's what I'm telling you.
It just rotates like that.
This will just do better, right?
Which is why you bought 3 in the beginning. You see that after owning rental properties for 20 years, you look back and you're like, you know what? This is how it goes.
Yeah.
And the fact that you had an eviction, I believe, with Mimosa pretty early on, doesn't mean that Minosa was a bad purchase or any worse of a purchase or any better of a purchase than the other 2 that you bought. Yeah. It's just how this goes every once in a while. And you build a portfolio, you build reserves in place. The other thing that is the tough thing about rental properties with Minosa specifically is the wonderful tens of thousands of dollars that you guys have earned in home price appreciation doesn't show up anywhere in your bank account. It's probably not in your net worth statement. It certainly doesn't show up when you're talking about some of the painful points at dinner. Yeah. It's hard to take that big picture perspective. For JWB, that's why we have reporting that helps our clients see this. Like I think it was Sam or Steve said, there's 4 years of suck. Well, I certainly don't hope you have 4 years of suck when you buy a JWB property. Yeah. There might be a moment of suck. You shouldn't have 4 years. But let's just say that even if you have a sucky moment, you can look at the big picture. You can see the tens of thousands of dollars of home price appreciation and principal pay down and tax savings. All those things are there and they matter. Yeah. They're just not front and center.
Yeah, makes sense. This was awesome, man.
Yeah.
We felt like a little secret behind the scenes here. Greg and I were like, man, is this really going to be a whole show?
I know.
We were preparing for other topics to talk about. Now we can save those topics for another show. We also have a handful more questions. We can save those questions for another show. So
sure.
Your question, Eddie's question, whoever's asking these anonymous questions about what we're seeing as far as like cash on hand and is rent softening and like the glut of inventory that may be happening.
Can save these because you know what we've got coming up next week?
The market update.
The market update. Probably this would be a great time to answer some of these questions, especially about rents.
Yeah, there you go. So we're going to answer the questions. So next week, market update.
Yep.
Right. We're going to answer some of those questions there. I think we're going to add these to a list of ongoing. We're trying to make the show more topical.
Yeah.
Right. So like you asking questions at the end of the show is the biggest favor that you can give us because we can then just continue this onto the next shows and like have these conversations and like not just answer on the spot, but have better takes.
Yeah.
And better discussions about it. So we're going to add these to the list next week. market update.
You know it.
Don't want to miss it.
You know it.
The big poobah. GC, any preview of kind of like what you're noodling on these days for
predictions?
Predictions.
I'm giving predictions.
This is GC's prediction.
I'm giving predictions. Yep.
Oh boy.
Yep. If you want to hear what we think is going to happen in the 2026 real estate market here in Jacksonville and beyond, tune in next week. I'm going to share.
5 years of doing shows with you.
I know.
I've never seen.
I knew you're going to like
great
that.
predictions.
I knew you're going to like
I
that.
picked that I will enjoy this show. This is going to be awesome, man. I'm really looking forward to what you're putting together.
Yeah.
So anyways, we want to thank everybody. We had 70 people on today, which is awesome.
Very cool.
So happy that you made time with us here. Thank you for being part of this conversation. It was actually a really good conversation of people like
Awesome.
pitching in questions and stuff like that. We're going to talk, more and more about this topical stuff. We'll have some shows where we're teaching specific concepts, but like the future of the show looks like this. A conversation, we've heard it over and over again. What everybody likes is feeling like you're in a conversation with friends talking about real estate.
I
so
love it.
and investing and stuff like that, right? So this is the direction that we're going. I hope everybody liked it. I encourage you all to come for the market update next week.
Yes.
You're not going to want to miss that when GC predicts. It's going to be great. And any other last piece of advice, GC?
Don't be average.